The Benefits of Portfolio Diversification by Lisa Rittenhouse. What is portfolio diversification? First, we need to understand what diversification means. Diversification is the averaging of independent risk in a large portfolio. Portfolio diversification is a widely embraced investment strategy that helps alleviate the instability of markets for investors. It has the key benefits of reducing portfolio loss and volatility, and is especially important during times of increased uncertainty. Understanding risk and return. Realized returns is the total return earned over a particular period of time. Average annual return is the average of realized returns for each year. Variance of returns is a measure of the variability of returns. Standard deviation or volatility of returns is the square root of the variance, which puts it in the same units as the average. 95% prediction interval is the range of returns within which we are 95% confident that next year's period's return will lie. Common risk is linked across outcomes. Independent risk are risks that bear no relation to one another. Benefits of risk reduction. Keeping your assets diversified will tend to keep your portfolio perform similar to the market as a whole. Diversification is the best way to increase the stability of your investments and decrease your risk of losing money in the event that a single area decreases in value. Diversification won't protect you from general market slowdowns, but it will maintain your portfolio's stability over time. Example, if you own 20 stocks in 20 different areas and one would take a dive, the chances that your portfolio would suffer is doubtful. Benefits, asset choices. When your assets are widely diversified, you can spread them out over broadly different forms of assets, including securities such as stocks and bonds, commodities such as oil and minerals, real estate, and cash. Each of the assets displays different strengths and weaknesses in terms of risk and profitability. Assets in these areas will help to create a stable portfolio which will increase in value over a period of time. And to the right of the screen, these are the different areas from low to high risk that you can see. Money market being low risk, and then foreign stock being one of the highest risk. Benefits, lower maintenance. Playing high stakes game with your assets and moving them to risky markets can be time consuming and can increase your risk financially. Diversified portfolio is less exciting but decreases the risks. Once you have your investments settled in securities and stocks, they can remain there for a long period of time, requiring very little maintenance. This will free up your time and cause less headaches and a better financial outcome. Ethics on investing. When it comes to investing, it is unethical to profit from investments that lead to misery or the suffering of others. Investing in drinking companies that lead to alcohol addiction or underage drinking. Investing in tobacco companies that lead to cancer or cancer from secondhand smoke. Investing in the adult entertainment industry, which we all know is unethical. And then investing in and profiting from oil, gas, mining companies that behave recklessly toward the environment. The Bible on diversification. The Bible verse that I found on investment is Proverbs 27:23. Be diligent to know the state of your flocks and attend to your herds. When it comes to investing, it is important to know what you are supporting and make sure that it brings glory to God and benefits people instead of hurting their well-being. Um, whatever we do it all for the glory of God. We need to make sure that our actions and our behavior, whether personal or professionally, is all for the good of God. I hope you've enjoyed my presentation. The next couple screens are my references. Thank you very much.